This is the absolutely insane high-stakes story of Warner Brothers Discovery. And if you stick with me, I'm going to walk you through my notes and break down exactly what's going on, because this isn't just a normal investment, it's a special situation, an event-driven poker game where the stakes couldn't be higher. So who exactly is Warner Brothers Discovery, or WBD stock ticker? Even if you don't know the corporate name, you absolutely know their stuff. This is the kingdom that owns HBO, the gold standard of television. They own Warner Brothers Studios, the creators of Harry Potter and The Matrix. They own the entire DC universe, Batman, Superman, Wonder Woman. And that's not all. They also own CNN, TNT Sports with the NBA, Discovery Channel, HGTV, and Food Network. It is, without a doubt, one of the most irreplaceable collections of content on planet Earth. These are what we call crown jewel assets. You just can't build another HBO overnight. So where did the problem start? Well, this giant was forged in a massive merger back in April 2022 when AT&T's Warner Media combined with Discovery, Inc. The idea was to create a media behemoth that could compete with Netflix and Disney in the streaming wars. But mergers like this come with a price tag, a huge one. And WBD was born with a crushing amount of debt on its balance sheet. Think of it like this. They bought the most beautiful mansion on the block, filled with priceless art and a legendary wine cellar. But to do it, they took out a mortgage so massive that the monthly payments are terrifying. From day one, the entire story for WBD was supposed to be about one thing and one thing only: paying down that debt. Management's primary job was to generate as much cash as possible to chip away at that mountain. For a while, that was the whole investment thesis, a slow, grinding, deleveraging story. Kind of boring, right? But then, on October 21st, 2025, everything changed. The board of directors dropped a bombshell. They announced they were launching a formal review of strategic alternatives. Now, that sounds boring corporate jargon, but let me translate it for you. That's the corporate equivalent of putting a giant for sale sign on the front lawn. They explicitly said they would consider selling the entire company or breaking it up and selling the pieces. Suddenly, the boring, slow-burn story was dead. It was replaced by an immediate, catalyst-driven, high-stakes drama. The question was no longer, can they pay their bills? The question became, who is going to buy them and for how much? You see where this is going. This single announcement transformed WBD from a regular stock into an event-driven special situation. And that's where things get really interesting. To understand the full picture, we have to look under the hood at the financials. And this is where most people get confused, because the numbers tell two completely different stories. It's a real Jekyll and Hyde situation. First, let's look at the scary stuff, the Dr. Jekyll side. As I mentioned, the company reported a GAAP net loss of over $11 billion for 2024. If you just saw that headline, you'd think the business was burning to the ground. And with a net debt load of $34.6 billion, their balance sheet looks strained, to say the least. There are metrics analysts use to measure financial distress, and WBD trips a few alarms. Its interest coverage ratio is less than 1, which basically means its operating profit isn't even enough to cover its interest payments for the year. That's a huge red flag. Then there's something called the Altman Z-score, a formula that predicts the likelihood of bankruptcy. A score below 1.8 is considered the distress zone. WBD score, a frightening 0.68. So, on one hand, you have an unprofitable company in the financial distress zone. Sounds terrible, right? But here's the part most people miss. That massive $11 billion loss, it's profoundly misleading. It's an accounting number, not a cash number. Buried inside that loss are billions of dollars in non-cash charges, things like goodwill impairment and amortization related to the merger. Let me give you a simple analogy. Imagine you bought a car for $30,000 5 years ago. This year, you sell it for $10,000. In your personal accounting for the year, you could say you have a $20,000 loss on that car. But did you actually lose $20,000 in cash this year? No, the cash is long gone. It's just an accounting entry reflecting the depreciation of an asset you bought in the past. That's kind of what's happening with WBD. A lot of that huge reported loss isn't from the day-to-day business operations, it's an accounting reflection of the massive merger. So what's the real number? The one that shows the actual health of the business. For that, we have to look at cash flow. This is the Mr. Hyde side of the story, the powerful hidden strength. Despite the scary headline loss, WBD generated a robust $4.4 billion in free cash flow in 2024. Free cash flow is the lifeblood of a company. It's the actual cash left over after running the business and paying for everything needed to keep it going. This is the money you can use to pay down debt, buy back stock, or invest in new projects. And generating $4.4 billion in cash is incredibly impressive for a company that's supposedly losing money. This is the core of the bull thesis. It's like a family with a gigantic mortgage, but they also have an incredibly high-paying and stable job. As long as that massive paycheck keeps hitting the bank account every month, they can manage the debt. WBD's free cash flow is that paycheck, and they are using it. In 2024 alone, they paid down over $5 billion in debt. They are proving they can, in fact, handle the debt load. This brings us to the valuation puzzle. How much is this company actually worth? Depending on which metric you use, you get wildly different answers. If you look at the price-to-earnings ratio at over 66, WBD looks prohibitively expensive. Compare that to Disney at 17 or Comcast at around 5. It looks like a joke. Based on this, you wouldn't touch the stock. But remember that E for earnings is distorted by all those non-cash charges. What happens if we look at it through a cash flow lens instead? Using a metric like price to free cash flow, WBD trades at around 12.5x. Suddenly, it looks reasonable, maybe even cheap, especially when you compare it to a streaming-centric peer like Netflix, which trades at a price to free cash flow of around 80x. So, which is it? Is WBD a value trap, a company that looks cheap but is actually just a mess of debt and declining businesses? Or is it an undervalued cash-generating machine whose true worth is being hidden by confusing accounting? That was the central debate for a long time, but now, with the strategic review, the market is leaning heavily toward the second answer. The logic is that a potential buyer, like Apple or Amazon, doesn't care about GAAP accounting. They care about two things: the world-class assets and the cash flow they generate. And this is where WBD made a very clever move, even before the official for sale sign went up. They announced a plan to separate the company into two publicly traded entities. The first would be streaming and studios. This would be the sexy part of the business: HBO, Warner Brothers Studios, DC, and the Max streaming service. This is the growth engine. The second company would be Global Linear Networks. This would house the legacy cable channels like CNN, TNT Sports, HGTV, and Food Network. These businesses are in slow, secular decline as people cut the cord, but they are incredibly profitable and generate enormous amounts of cash. They're cash cows. Now, why is this so smart? Think about the potential buyers. A company like Apple has zero interest in owning a portfolio of declining cable channels. It would be a headache. What they want is the content engine, the studios, the IP, the streaming platform to supercharge Apple TV+. By creating a plan to separate the two, WBD was essentially cleaning up the good assets to make them a perfect, bite-sized acquisition target for a tech giant. It's like they're selling a massive estate. They're saying, hey, we know you really just want the mansion in the vineyards. Don't worry about the old leaky farmhouse out back. We'll deal with that separately. This makes a potential deal so much simpler and more attractive. The announcement of the strategic review just made this official. The market is now betting that a deal will happen. We've seen the stock price surge from around $12 to over $19 on this speculation. This isn't random market noise. It's a direct reaction to a fundamental shift in the company's story. The market is pricing in a takeout premium, assuming a buyer will have to pay significantly more than the current price to acquire these assets. But here's where we have to be honest and balanced. This is a high-wire act, and there are very real risks involved. An investment in WBD right now is not for the faint of heart. It's for investors with a high tolerance for risk, who understand event-driven situations and who believe in the probability of a sale.
For more conservative investors, the prudent move is to stay on the sidelines and wait for the dust to settle. And hey, I hope this video helps you on your quest for profits. Catch you on the next one.